everyone, and welcome. Today, we're going to tackle maybe the most important relationship in all of investing, that constant push and pull between risk and reward. Seriously, understanding this one concept is the key to making smarter decisions with your money. So let's dive in. You ever wonder about this? You hear one friend talking about their savings account and it's earning practically nothing. Then another friend is all excited about some stock they think is going to double. What's the deal? What's the big difference between those two worlds? Well, it all boils down to these two little words: risk and reward. And trust me, really getting a handle on how these two work together is your first and biggest step toward becoming a way more confident investor. All right, so first things first, let's get on the same page and break down what we even mean when we say risk and reward in the investing world. Okay, let's start with risk. And yeah, this is the one that makes people a little nervous, right? For good reason. Unlike money in a bank, investments aren't guaranteed. Risk is just the chance that the value of your investment could go down. And in a worst case scenario, yep, you could lose everything. It's super important to know that up front. But on the flip side, we've got the reward. And this is the exciting part. This is why we invest in the first place. It's the potential for your money to actually start working for you, to grow over time and give you a positive return on your investment. Now, here's where it gets really interesting. Risk and reward aren't two separate ideas. Think of them more like dance partners. They're totally connected. And that relationship is what drives pretty much the entire market. This quote absolutely nails the golden rule of investing. If you're hoping for a shot at those bigger returns, you have to be willing to accept more risk. There's just no such thing as a high return, zero risk investment. It doesn't exist. That's the fundamental trade-off. And this chart is a perfect way to see it in action. Look all the way on the left. You've got a savings account. It's super, super safe, but the reward? Almost nothing. As you move to the right, through things like bonds, index funds, and then single stocks, you can see how both the risk and the potential reward just keep climbing together. And that takes us all the way to the far right with crypto, where the potential for reward can be huge, but the risk is also extremely high. The volatility can be just wild. But let's dig a little deeper here, because risk isn't just one simple thing. It actually comes in a few different flavors, and it's really helpful to know what they are. First, you've got market risk. This is the big one. Think of it like the tide. When the tide goes out, all the boats go down with it, right? It doesn't matter how great your individual company is. When a major economic event happens, like the 2008 financial crisis, the whole market can fall. You can't avoid this just by picking a good stock. Then there's this other, much sneakier kind of risk called inflation risk. This is the one that quietly eats away at your savings. It's the danger that your money, even if it's sitting in a safe account, isn't growing fast enough to keep up with rising prices. So your money actually loses its buying power. A dollar today just won't buy you as much next year. It's a funny thing. By trying to avoid all investment risk, you can walk right into inflation risk. Okay, so if risk is pretty much everywhere, what are you supposed to do? Just throw your hands up? No way. There are smart ways to manage it. The most powerful tool in your toolbox is diversification. You've heard the old saying, don't put all your eggs in one basket. And honestly, it's cliched for a reason. It's 100% true. When you spread your money across different types of assets, say some stocks, some bonds, some real estate, they don't all move in the same direction at the same time. So if one part of your portfolio takes a hit, the other parts can help cushion the blow. So we've got the basic theory down, but this isn't just a textbook lesson. Let's make this personal, because the most important question is, how does all of this apply to you? Yeah, I'm talking to you, because the right amount of risk for your best friend or your parents or some analyst you see on TV, well, it's probably not the right amount for you. Your investment strategy has to be personal. So how do you figure out your own risk tolerance? Well, it comes down to asking yourself three key questions. 1, what are your goals? Are you saving for a down payment in 5 years or for retirement in 30? 2, what's your time horizon? That's just how long you have until you need the money. And 3, what's your personal comfort level? How well can you sleep at night when the markets get choppy? Let's look at what this looks like in practice. Here's a pretty common balanced portfolio. This might be for someone with a medium risk tolerance, maybe with about 15 years till retirement. That 60% in stocks is their engine for growth. But that 40% in bonds, that's the shock absorber. It's there to add stability. Now compare that to this, an aggressive portfolio. This might be for a younger investor with decades to go. They're going nearly all in on growth with 90% in stocks. They're basically saying they have enough time to ride out the market's ups and downs for a shot at bigger long-term returns. It's going to be a much bumpier journey, for sure, but the potential payoff is higher. And that's really the key thing to remember. There's no single right answer here. There is no magic one-size-fits-all portfolio. It's all about figuring out your own goals, your own timeline, and then building a mix of investments that feels right for your journey. So, to bring it all home, you just can't escape risk. It's part of the game, but you can understand it and you can manage it. The goal isn't to avoid risk entirely. It's about making a conscious choice, deciding which risks you're comfortable taking to get the rewards you're aiming for. Thanks so much for hanging out with us for this explainer. Really understanding this balance between risk and reward is your first massive step on a successful investing journey. Learn, invest, repeat.